Hello and welcome to New Waves, the podcast where we dive into one big question. What's making waves in the climate tech ecosystem this week? Joining me today are Maxi, principal at HV Capital, Yair, general partner at Extantia, and Jonny, founder at Marble. And in today's episode, we'll unpack what's really happening inside Stegra, one of Europe's largest green steel projects. We'll chat about All Aboard, a new initiative that's uniting top investors to co-invest and close the scale-up funding gap. And we will quickly chat about AI as an accelerator for fusion. Before we jump in, don't forget to subscribe on YouTube or to follow us on Spotify and Apple Podcasts. New episodes of New Wave Weekly drop every Friday at 9 a.m. CET. All right, let's get into it. Welcome back again. New Wave episode 4 or 5, I can't remember by now. Really excited to have this new crew with me today. Yair and Maxi's first appearance in the podcast. Super excited to have you guys. Cool. Well, in the news, big news, a lot of people are talking about it. We have a company called Stegra, formerly H2 Green Steel, based in Sweden, trying to build one of Europe's largest green steel plants. They've raised about 6.5 billion euros so far, from major investors like Mercedes-Benz and others. And on September 23rd, they announced an offtake agreement with Microsoft, so felt like everything was going well. And then, bada boom, the Financial Times publishes an article 3 weeks later to say that Stegra is facing a funding crisis with potentially a 1.5 billion gap. So that's the context for today's discussion. Jonny, I'd love to start with you. What is Stegra doing exactly, and what's the origin story of the company?
Yeah, so this is a huge bet on green steel, and Stegra's proposition is really to be one of the first industrially relevant end-to-end green steel producers. As you mentioned, it was spun out of 2020 out of Vargas Holdings. That's important. We're going to come back to that. A venture builder who have also spun out another company we might have heard of called Northvolt. And both of these companies follow a pretty similar playbook, which is to try to do something relatively technically proven on an industrially very large scale and use that as a way to unlock commercial offtake agreements with customers in order to kind of skip the scale-up phases that we often talk about in industrial clean tech. Stegra specifically is trying to do end-to-end green steel with three things. So one is a truck ton of renewable energy. So at capacity, they're targeting 8 to 10 terawatts I believe, of renewable energy, which is a lot. That's about 2% of the entire grid of Sweden. They then want to plug that into a 700 megawatt electrolyzer. That's a very big electrolyzer, again, so that's quite a big challenge to undertake. And then they want to feed into a direct reduction tower, and then ultimately have the electric arc furnace and a rolling mill, and ultimately take off fully green steel at the other end. I think they're targeting something like 5 tons, if I'm not mistaken. As you said, they've raised billions of dollars already. They're looking for another billion. There seems to be a lot of challenges right now around the infrastructure. There's delays on grants. They're having to take more ownership of other parts of the value chain, including like rail and logistics. And yeah, I'm curious to see how this one plays out. The Northvolt story is fresh in everyone's mind. I think it's important that Europe keeps this scale of ambition, right? We should be building big, important stuff that is ambitious and bold and challenging. But it is a bit worrying to see a similar sort of pattern maybe start to emerge.
Yeah, is that your read on the situation as well? I was reading through the article from the Financial Times. The title is quite, I would say, scary, but then you read through the details and it feels like it's not that big of a deal, or at least like they are not done yet. So what's your read on the situation?
Look, for sure. First of all, journalists are looking for blood, right? So, and it doesn't matter if it's true or not true or semi-true, right? It's enough to publish a big article and go out and say, oh, another failure. Let's say celebrate the failures instead of celebrating the success. I don't bash the journalists. It's part of their business model. But it doesn't mean necessarily that is the reality. Yeah? The fact that a project in the order of magnitude that Jonny was just talking about requires more capital And in this order of magnitude, it requires big capital in the billions. Overrunning cost is not unusual. In fact, every plant, everything you do first, have a look how much was it to build the Berlin airport, right? I mean, all these infrastructure, big things that you build for the first time, they run over time, they run over budget. I think there is a statistic that the infrastructure stuff is over 90% of them run over time, over budget. So in itself, it's not news. What is news is, of course, is that it's a poster child. It's VC-backed money. It's green steel. It's something new, and everybody's talking in Northvolt context, and that's where I think people start to poke holes and say, does it work, and et cetera, et cetera. But we can go into that in a second.
I mean, I agree with you on the ambition, right? I think we're aligned that like Europe needs to build big things. These things cost billions of dollars, and these things are complicated to build. I think we should revisit why these things are so complicated to build at some point, because it didn't used to be the way, seemingly. But I do think there's a slight risk here, which is like the technology steps that they're trying to unlock are not necessarily as proven out even as they were in Northvolt, right? In Northvolt, you were talking about a largely copy paste of, a lot of processes that are pretty well worn. And there were still challenges that resulted in terms of scaling that to some industrial level. Here, chaining together these 3 or 4 big elements, they're really exposing themselves to a lot of difficulty in terms of delivering that at that scale. And I think also the fact that they're in Sweden again, and the Swedish government is going to be, I'd imagine getting their asses kicked by the people in terms of what happened with Northvolt and the kind of the money sink. I think there's also a political risk that Stegra becomes like a poster child for, not throwing more good money after bad. But I don't think that's a good thing for the ecosystem. I agree with you, Yair, that we should be building these big projects. Sometimes they take a long time. And if you look at the amount of capital that, say, China deploys into some of these infrastructure projects, $1 billion really is a drop in the ocean. So I agree there needs to be some, take it with a pinch of salt. But I think there are some flags to pay attention to.
I mean, I think there are 2 perspectives to take. I think one is the one Yair shared, and I agree with that mostly, right? If you have a big first commercial plant, and I think Stegra has a funding gap of 1 to 1.5 billion, which they say is 15% of their budgeted project costs, which to Yair's point isn't abnormal, at all to see cost overruns of 15, 20, 30% for a first commercial plant, or in other cases, even 2 to 3x over costs or so. I do think that's valid. I think there's another perspective to take. Steel is a commodity, and it's all about costs in the end. And so I think the other perspective would be that managing CapEx and OpEx and really managing your runway, that you have enough time to scale up the technology to actually move down the cost curve and reach prices that are competitive is so core to the business that it, can also, you could say, raises a more fundamental question around, controlling costs, manufacturing, know-how, etc., than in other areas.
But is that not what you expect from a large project like that, which is, as you said, it's a first of kind, right? At this scale, so you would expect also to see some of this overcost and delays, and as you said earlier,
I think it's important. We've kind of used the term first of a kind for this. This is way beyond first of a kind. This is a full commercial what they're trying to do, and that's the whole thesis, right? That's the Vargas playbook. They talked about it a lot. They were kind of the darling of this idea of gigascaling, of let's skip all these incremental steps. Let's just go to the end. Let's use proven technology. We don't have time to waste. And with that, we can unlock all this capital because we're doing things immediately at an industrially relevant scale. I think that's a very interesting model. The question is, if you skip those steps, if you skip the increments of going from your first of a kind and taking those learnings and then scaling that up another factor and then scaling that up another factor, it's a frustrating playbook. I get that. And I would love that we could just, clack our fingers and everything was built at industrial scale immediately. But the fact of the matter is we suck at building big infrastructure projects, right? This is, whether we're talking about roads, rail, look at HS2 in the UK. That eventually got scrapped and we got to Birmingham. So I don't think this is just a climate problem, but I think by tying these ambitions in the climate tech space and taking these huge singular bets where you do skip all those learnings and you do skip that kind of scale up phase, there's a lot of value to do it if you can get there. The question is, can you navigate that level of complexity in such a large project all at the same time, all at once? Or does that just become, a cake that's far too big for any one person to eat? That was a weird analogy, but I'm going to roll with it.
I'll continue that thought because basically what you skip is not just the technology, the incremental technology proving points that Jonny was talking about and jumping to the end. You're also skipping the capital stack. Basically, you're jumping from early stage VC to late stage infrastructure. Okay. Now, in late stage infrastructure, you have billion-dollar funds that are financing billion-dollar plans and projects. And like we said, it's not unusual that those run over time and over budget. But again, you have those billion-dollar backers that are standing there and are very experienced in those and know how to do that, okay? But what we see here in this case is you bring together a bunch of early-stage investors and sometimes a bunch of late-stage, and even you persuade some banks to go into something that is still early. And then when the shit hits the fan, then you will figure out that all of a sudden you're left with early stage financing. And early stage financing doesn't have billions for overrun projects. And that's where things are starting to become very complicated.
Yeah, Yair and me had an interesting discussion about that a while ago. I think the problem is that often, investors that get in a certain stage, say early stage VC, also don't know or fully think through the entire journey of lowering, moving down the cost of capital curve, and how do you actually get to a big exit, right? Like usually, when you have a first commercial plant and you've built that, and then, the startup goes to a bank or big infra player, that's still way too early for them. But there are people in between that have expectations on ownership, and entry prices and so on. And I think sometimes a lot of money gets put in by early stage VCs, the valuations are quite large, and you make it very difficult for that companies to find a path to actually get to those, infra players and type of funding later on.
I think there's also, though, to the point on financing, Maxi, like there's also a challenge, I think, with this model where you're basically pre-banking these offtakes, right? So you're saying, okay, we're going to do this at a really large scale. And that then allows you to get in the room with, in this case, Microsoft, and they then make some sort of commitment. I think we should talk about whether that is, a real thing or not. We should discuss that. But then what was interesting is if you look at kind of what happened there with Northvolt is they had all those commitments. They used those to finance and get to this kind of late stage infra scale. But then they couldn't start to make good on those deliveries because there was problems. And then you've kind of sweated your last financial asset at that point, right? Like, at what do you then finance on the back of at that point? Because you've already used that, you've shot that bullet, you've sweated that. Where do you go next? And I think that's kind of one of the challenges of this particular approach and this model is that sometimes you will need government or so on and so forth to kind of step in, or other kind of actors. And, looking on Twitter, when I was looking at Stegra before, there's a lot of like angry Swedish tweets. Now, I didn't translate them all, but I think there will be like negative sentiment, which is a shame, but there will be negative sentiment around something this close to the Northvolt collapse that I think will, influence the government's likelihood to step in. And then the question becomes, is just where do you go to get that cash if things don't pass the mustard, not now, but even later? If they get through this hurdle and they start to produce, what if they don't get to the scale they need? What if there's other overruns or other over delays? Like, you can't sweat the same offtake multiple times before you've delivered on any of it, I think. And Yair, what's your take? Because you're Mr. Offtake, so you know about this stuff.
Look, I think the challenge that I see is that it's at the end, we're not in the business of climate or climate tech. We're VCs, and we're in the business of placing opportunities on the right place in the cost curve, in the capital cost curve. This is our business. And everything that comes at our desk is we need to assess what is the risk that we are underwriting and what is the reward. And what is it, like Maxi said, this is the discussion that we're doing all the time, right? I mean, do we actually understand the risk? What is the need of capital that is going to come after us? Because if we don't do that correctly, what happens is that in a first of a kind, an off-take agreement and etc., right? Everything looks very rosy. But instead of my 20 million, the company, in order to cross the bar to start producing and deliver on the offtake agreement, they need another 20 million or another 30 million. And you know what? The raise on that capital is still going to be at the same valuation. So my whole ownership in the company is going to be diluted significantly. And the exit is still going to be the same exit. So my return profile is now just dropped by, 40, 50%, which is, and again, we're not in climate. We're in the business of making, in the business of making money. And that's how we manage other people's money. We have fiduciary duty. And this is the question. This is the challenge. This is the challenge that it's not, off-take agreements are great. This is one thing that one risk that we can say, okay, check. But then engineering, manufacturing, that's the next one. And if we miscalculate that, the penalty is huge.
How do you assess that, Yair? Because obviously, I'm in the process of learning the craft of VC, right? And people have told me, if you have an offtake agreement, then perfect. It's a great company. They have customers. Yoo-hoo! Right? And then you tell me, no, there is something else. So how do you assess that, Yair?
Maxi, you're with the growth people.
I mean, I comment a little bit on offtake, right? To your question, Hugo. I think obviously the idea of offtakes is guaranteeing cash flows, right? You ideally have a fixed volume and price over a couple of years, which in theory makes your project bankable, and that's why you can get, debt or lower cost of capital. I think the problem in practice and why it's not a magic bullet, I mean, we've seen in Northvolt, right? Customers also stepping back from offtake agreements once something is delayed. So even if on, as a VC, you look into the terms, it looks binding, like there is a hard commitment. I think in the end, when a startup goes into an offtake agreement with a large corporate customer, there's nearly always, a breakup clause in terms of delivering the product on time, on spec, and many other things that if the corporate customer wants to get out of the offtake agreement, there is probably a way to do so, even if it looks binding, right? And then if you are a startup scale up, are you really going to sue that customer? It's going to take a lot of money and a lot of time to enter in such a process. You potentially get a couple of million in damages, but then who's going to be your next offtake customer as well if you have a history of going into that? So, to me, yes, we look at the offtake agreement and it's important, but it's not a magic bullet, that means you don't have to move down the cost of capital curve anymore, and you don't have to do the de-risking to actually be able to deliver on time, at a price that allows you to make a margin, and etc. So the manufacturing side should be as much part of the diligence as the demand side.
And I think on that, there's a specific thing that is worrying in this case. And I'm not trying to, pour cold water on this. I think this is a really exciting project that should exist. I want to say that for sure. But something that's worrying in that context, Maxi, is this is, as I understand it, more money to just get to the stage that they haven't yet got to, right? It's basically including things that they didn't think they'd have to pay for previously. So that 15% overrun is very acceptable, as we talked about, but it's not then getting them to an equity inflection point in the narrative, right? It's not then to get them to a stage where they could then prove some sort of value that they were needing in order to get another offtake or in order to get closer to delivering their offtake or so on and so forth. It's just, I think, to keep the project on track is actually they now need to accommodate these other things. And I think that just makes, to Yair's point, the equity narrative and the value inflection a bit complicated there. But I hope it works. I hope we produce a crap ton of European green steel. To be very clear, I just interesting times.
For sure. And then just to bring back a bit of a positive note, if you read through the details, some of the investors are quite positive. That the CEO is also saying that it's different to Northvolt in terms of the story. Well, what's the truth? I don't know, right? But at least like there is
What
a
do
positive
they
note.
say?
Yeah, guys, you got us. Sorry. Yeah, damn.
Right.
He must really be hating that analogy right now. I bet he's sick to the back teeth with being asked about Northvolt. I can imagine. Probably has a swear jar in his house for Northvolt every time someone mentions that.
Yes, of course, which you have done, Jonny, in this episode so far. Probably two or three times.
I didn't mention it. I only mentioned it a couple of times. I hate to draw parallels.
Well, to draw a parallel there, I think there's something quite interesting because in terms of the timeline, that was quite insightful for me. So that article from the Financial Times was on the 13th of October. And then on the 16th of October, there is this company in Germany called SHS, which just raised 2 billion for green steel projects. So obviously you have to compare. The big difference there is this company is already in the business of producing steel and is just trying to cut out the CO2 emissions, and he's doing it with a very different approach, which is like step by step in the process. What's your read on that situation, like having a big corporate undertaking somehow of the same project, but with a different approach, right?
Yeah, I mean, from my perspective, this is nothing new. In fact, the entire topic of first of a kind, and I know I'm the one that contributed quite a lot to this discussion. Now I'm backpedaling. Undo the harm. But it all started when we invested in technologies, in climate technologies, that we saw that, okay, now they need to scale. Now we need to build these big plants and scale ups, etc. Right? This is where they started. But for the past 100 years, new technologies came to the market and new plants with new technologies were built. They were not even being talked as first of a kind, maybe, or definitely not in the context of the VC or the climate tech VC context. It's just that all these big corporates have taken the risk on the balance sheet with the debt that they already have, that is supported, that they got that and raised that debt, that is supported by the fact that they have an existing business. And with that, they also built new stuff and new facilities. And some of them worked and some of them didn't. But this is on the balance sheet money of the corporates, and it's in the entire performance then judged of the corporate, and not as a single plant supported by a single VC, by a single grant from the government, etc., etc. And then you're in the spotlight with all the challenges.
So in other words, you're saying that if they mess it up, it's not, it's their problem. And
there are so many DRI projects that were announced that didn't happen. ThyssenKrupp announced that they're going to do DRI, and then they got 500 million from the government, and then they stopped it, and they already consumed the grant. So it was a big scandal, but it wasn't unheard of business, in the bigger scheme of things of ThyssenKrupp, for example.
I guess on that specific example, but it's like if corporates are starting to speak projects, as you said on the balance sheets, I guess are we out of a job in climate VC, right? You know what I mean? Like if they're doing it on their own, like do they need us really? I'm kidding, but of course, like what does it mean when we have like big corporates taking on the projects that I guess versus startups? It's like almost they are going like back to back in the same area, trying to play the same game, but one of them has already years of experience in making steel, right? So unfair advantage there. How do we think about that?
Jonny, what are we going to do when we're out of job?
It's a very good question. Look, I think these two things are not mutually exclusive. And I think that these things have, interesting relationships between them on both sides. The corporates obviously, hopefully, are still going to invest in new technology, invest in new processes. A number of those new technologies and new processes may well be startups that were created to try and solve elements or problems within that value chain, right? If you think about steel, there are multiple different companies who are actually attacking a specific component part of that value chain today and are offering a better, cheaper, faster, and greener, as some people say, alternative to incumbent fossil-based processes. So you may see a world where some of that 2 billion is actually spent on deploying startup technology in that value chain, right? In other instances, you may see them doing retrofits with more established technology. And so I don't think these two things are mutually exclusive. I think corporates will always struggle to move quickly and to test new technology and to be agile and versatile. But we were talking about how difficult it is to build really, really big stuff. They know how to do that, right? Oil and gas knows how to build really, really big stuff. A lot of these industrials know how to build really, really big factories because they've done it more recently, much more recently than a lot of people that are entering this space even. So I think there's always this interesting symbiosis that we can start to create. And I think the fact that they're investing, or as Yair said, off their balance sheet and raising off their balance sheet to do these projects, it will create less scrutiny on whether that project lives or dies, right? I bet you if nothing comes of that in 3 years, we probably may never hear about it, or certainly it'll be hard to go and find out about. But if Stegra dies, you can bet your bottom dollar that's going to be all over the front page of most major national publications. So there is a different bar of failure, ironically, to people who are trying to do stuff that is new and ambitious and inventive and challenging, and to corporates who are also trying to do stuff and often failing, but just failing discreetly and much more quietly, in most cases, not in all. So yeah, I think there is something symbiotic to be said, and I completely agree with Yair's point that there is an unfairness in the judgment of failure between those two setups.
Well, I guess before we switch topics, anything else on Stegra, or did we cover everything?
The last thing I want to say is when I was reading about Stegra and we were talking about this, it reminded me of an essay. It's not about steel, but it's an essay by one of the Collinson brothers called FAST, F-A-S-T, FAST. And it's basically just a list of all the cool stuff that was built really, really quickly, largely before the 1970s. And then how ridiculously long a lot of stuff tends to take today. And I think it's an interesting thing just to read. It's a very short just collection of projects. But just to see how much worse we've got at building really ambitious things really, really quickly, it's quite startling. And I don't think it's just a climate problem, but we intersect a lot with industry and intersect a lot with heavy industry. And so it is going to become more acute for our world than it is for a lot of other people. But why we can't build more stuff, I think, is a problem that we really need to solve in the West, right? And it is a very Western problem if we look at how China's developing and Asia's developing. And I think there are some structural issues that we need to address if large-scale projects of any kind are going to be deployed quickly, and time is a critical ingredient in climate. So I think there are challenges we need to solve for that are bigger than Stegra itself.
And Yair, maybe to that point, I think that's very much of a Western problem, because I think you've spent time in China this summer, no? Did you not travel to China and realize?
Yeah, I was there in July, looking to be encouraging all the topics that are not investable anymore.
If maybe for the people on the podcast that can't go to China right now, second reading recommendation from my side is Dan Wang Breakneck, China's Quest to Engineer the Future, which, to Jonny's point, I think shows a lot of what we can learn, from China building up those projects and also having the process and manufacturing know-how to scale up a lot of technologies.
Great. Love that. Thank you for the recommendation. Well, to Jonny's point, we got good now at building vibe coding and websites and funny images of cats with AI. So we've learned some things along the way that we didn't know how to do before, huh? Let's switch topics. Another quite interesting initiative that we came across this week is All Aboard, a collaborative fund, I guess, or an initiative of a collaboration between multiple funds. I think 13 of them, including Breakthrough Energy. I think Coastal Venture is also part of it. We want to take the lead on just explaining quickly what this initiative is, and then I guess we can cover a bit more about like what it means for the ecosystem?
I mean, I can introduce it quickly, but All Aboard is basically, I think, a 300 million, at least target US dollar co-investment fund. And the idea is similar, I guess, to how in Europe we have some, public institution matching private funds to scale up technology, that if there is a syndicate of strong private investors, Hugo, you mentioned Khosla and others are part of the initiative, then this fund is basically matching the funds, and it's specifically targeting commercial plants, whether that's the first or second, that are still quite risky, maybe too risky to get funded by the infra funds, the banks of this world, but those rounds can be $100 million plus, so often are also too large for traditional VCs, or at least sort of a fund on its own. So it's kind of a collaborative effort to really scale up climate and energy companies. Yeah, feel free to jump in.
Yeah, it should be noted, Maxi and I visited the last gathering that was in San Francisco of this initiative led by the founder of TikTok, Chris Anderson, and we've met a lot of other investors and players in the market over there. And I think what is to admire is the sincere desire of everybody in the ecosystem. I think generally all of us in the ecosystem, I mean, we're all competitors on day-to-day basis. That is not to forget. We're running a business, but at the same time, we're all driven by a mission, and that mission is bigger than us and bigger than a single fund, and we will not get there if we will not collaborate. And that initiative is there to increase collaboration. And I think it's any such initiative is very welcome. And it was very nice to have a few more European faces over there. We felt very alone.
There's room for more next year.
There is definitely room for more, and that is why we were there, basically.
But so are you guys participating? Is it pan-European US? Because when I was reading up on it, it seemed just US funds right now.
At the moment, it's just US funds.
Yeah, because for context, there's basically like a yearly gathering, and then there is a fund that co-invests, and on the co-investment side, I think it's 13 US fund. The way it works, from what I've read, is basically if 3 or more coalition members invest in a round and meets all of the criteria of all aboard, then they will invest up to 45 million automatically, which is quite an interesting model. I was chatting to LPs on a panel last week that we've recorded that probably will come out just after this podcast. And one of the things they mentioned is that we lack a lot of scale up or growth capital, if you will. Is that the way we are solving for that? Is just like collaborating more is a way to solve for the growth capital that we don't have in Europe? And if yes, then should we expect all aboard Europe version soon?
I mean, I think the thing that's nice about it in terms of collaboration, and to Yair's point, right, we are all VC, so we are all competitive to some extent, right? But I think the question going into a round where you finance the first or second, commercial plant or project is, do you optimize for ownership, right? And that would mean kind of doing it alone, putting a larger ticket, getting a larger share of the company, or do you optimize for a, syndicate that is sustainable and can finance this company through, some of the maybe delays, overruns, changes in the world, tariffs, and so on that happen, along the way. And I think at least my perspective is that, in certain types or investments, maybe going in a bit lower on the ownership, but kind of having a cap table that if you have a 10 million, 20 million funding gap at a point in time, you're close to project completion, all the quotes are coming in, some higher than expected. Do you really want to go fundraising then and dilute yourself much further, or kind of have a cap table, around that can, kind of plug such holes quickly? So I think it's, generally good for the companies to have a syndicate with multiple sort of deep-pocketed funds who financed hardware before.
And out of interest, where is the actual 300 million coming from? Because that wasn't super clear for me. Is each GP making a commit? Is it a part of each fund? Like, how is that actually structured underneath?
No, this is being raised separately by the organizers of the initiative, and most probably, that's my personal opinion, most probably is more philanthropic capital, I would say.
And what would you say of philanthropic capital? Yeah, do you think like in terms of raising or in terms of how it's considered? Because obviously, from a performance perspective, it should be basically you take the top investments from that coalition of certain funds and then you put money into it. So from a performance perspective, I would expect it to be quite good, actually.
It's not about performance. It's about the fact of structure. Okay, and if you have a vehicle that is loosely being managed in terms of governance, of picking deals, etc., it's just matching. This is again, this is nothing bad or good. The reality is that LPs and most institutional LPs are working in buckets, in very structured forms. And they are not usually giving capital to a structure that is matching other people's money. If they want to give money to KOSLA, they will give money to KOSLA. If they want to give money to someone else, they will give money directly to those funds, rather than a vehicle that is matching.
Yeah, it makes way more sense, because I when I was reading about this and trying to get up to speed, it felt a bit weird that, you could in theory be an LP and fund, I know, in KOSLA, let's take it as an example, and then if suddenly I'm also an LP in this matching fund, I double my exposure to certain companies, right? We talked to Maxi, you said that brilliantly earlier with Stegra, right? It's singular bets, and I think that would be a huge, I guess, risk from an LP point of view. So it kind of makes sense to use like a philanthropic pocket that they manage. I think it's an interesting concept, and again, it's interesting that the US, this is a private market problem, and in Europe, this would be a public markets problem, and we'd be waiting for the EIB or someone similar to come up with this type of mechanism. So
I think it gives optionality, right? I think in Europe, Jonny, to your point, at some point, if you have this, hardware intensive kind of company, and you want to take European money, you'll have to scale up with public money, right? Whether that's EIB or KfW in Germany, or I guess BPI in France is probably the equivalent. Like there are these, public money institutions around, while, in the US, and that's why I really like the initiative, they're kind of trying to open up another path, right? As well, where you can actually scale with private money all the way. And I think it's a good option to have.
Yeah, for sure. I mean, I was shocked. I was actually sat with this guy, Yair, at New York Climate Week, and we were in a talk that was basically telling American domiciled companies and founders about how great Europe is because they've got all these grants and they've got all this money to support your capital projects. So I kind of looked at Yair like, what the hell is going on? But I feel like actually, when you look at like our non-dilutive structure and you look at what's happened in the US, there are a lot of benefits to still, I think, building in Europe. We talk a lot about the dearth of growth cap in the private market, and I think that is a real issue. But then look at the grant market and the public finance markets, pretty impressive, and arguably a lot larger than that 300 million. So I think if we could have public-private initiatives like that on both sides of the Atlantic, it would be interesting.
It's worth saying something about this talk that we were at. There were two challenges in this talk. One is that it was on a Thursday, and by the end of Climate Week, I don't know about Jonny, you looked refreshed, but I was very tired already.
I was fresh as a daisy. I'd just been on some sort of, I don't know, it was a run or a paddle morning or something like that. No, I think I skipped the morning events, unfortunately.
And the second, it was really fascinating that, I still remember when Biden and the IRA started, everybody was packing their bags and moving to the US. And then you're in New York in Climate Week, and people are talking how to move and what you need to do in order to get grants in Europe.
It was so bizarre. It was really like, people had invented fire, It was like, what? Like free money? Europe? Grants are good, governments help. It was kind of crazy to see. The one other thing that was very actually frustrating about that, just to cap this off, that he talked about is, when there was the flee to the US for the IRA, almost unilaterally there was the Delaware flip, right? So these companies were becoming US topcos, US domiciled companies. The conversation that was happening there was about the fact that actually you don't need to be a European domiciled company. You just need, a post box or an employee in Amsterdam or wherever the hell, and then you can start to apply for these grants. And I'm very pro climate. I'm very pro us building things wherever they may be. And I'm very pro people coming to build in Europe and the jobs it will create and yada, yada. But I do think Europe needs to be a bit more restrictive on where the value accumulates to in those types of projects. Because if we're constantly granting and subsidizing the first factories and the first projects, but the top co is sat outside of Europe, then ultimately we're not going to have mechanisms to, really reap the benefits of those ultimately tax dollars that we can then hopefully use to reinvigorate the system one more time. So that was a bit of a frustrating outcome, as much as I was happy to hear everyone being so long on the advantages of building in Europe as an American, which is unusual.
That's exactly the point, right? And everybody's aware the unicorns, they're in America. Why are they in America? Because we funded them in Europe.
Yeah, we're doing a lot of the value creation, but not so much of the value capture.
I mean, it's there are several of them. Yeah.
Yeah. To your point, I was listening this weekend to one of the 20 VC podcasts with KKR, and they were saying that a lot of LPs as well are either American or from the Middle East, and basically like all the way up, like the money goes out of Europe, not into European LPs, which also is also a problem in itself. The last topic for today, very short and brief, AI as an accelerator for fusion.
This is the short topic.
Yeah. Let's solve fusion in 10 minutes. I think that should be fine.
Exactly right. You can do that, Jonny. I know that. No, I mean, I have only the buzzwords there, like AI, fusion, everything. But basically, I was reading an article from TechCrunch, which talked about Google DeepMind and how they apply AI to help Commonwealth Fusion, to bring fusion to life. Maxi, you're the deep tech expert in the call, not to say that Yair and Jonny are not, but you're the deep tech expert. How can we use AI to, and is AI actually the driver of the energy transition? Big question.
Big questions and maybe two pieces, right? My understanding of what they're doing is sort of Google using DeepMind software to help. How do you simulate plasma, right? And how does actually plasma behave inside a fusion machine, and how can you sort of, optimize getting energy, from plasma, and at some point maybe controlling sort of the machine as well, right? So I think that's my understanding of Hugo, the article, you're referencing, and which I guess is a normal application of AI to some extent. And then I think the other question that's maybe the bigger one is to what extent are hyperscalers, AI, data center build out, kind of fueling or financing climate and energy scale-ups and startups currently. And I think that's probably the, more interesting one to me, because we see it across the board, whether it's, purchasing agreements for fusion power, in the future, whether it's energy storage, modules, etc. And I think the question again is how much of that is, marketing on the side of the hyperscalers versus how much of that are, commitments and relationships that really help, scale those energy startups, whether that's fusion or geothermal or another source.
I think Maxi's totally right. I think that the most exciting thing that AI could do is push us much faster to decarbonize and bring on a lot of crazy volumes of energy that are clean way, way, way faster than it would if it wasn't there. I think it's super exciting that this is a tech that's, sitting in that sort of software-ish world where there's lots more money, there's lots more investors, there's lots more people willing to throw cash and throw dollars at it. But in order to scale, it's a hungry beast, right? It needs feeding. And what it needs feeding is a truck ton of energy. And so ironically, that hunger could be one of the biggest drivers we have for industrial decarb, because we are going to have to find new baseload power. We are going to have to find geothermal, maybe fusion. We're going to find other ways to fuel these things. And that will create critical unlocks that will ripple, hopefully, down the rest of the stack. I actually was emailed, I think this weekend, by Schilps, who's from Opna. And she's released a really interesting report that if people are interested in this, I think is worth a read. It's called AI Infrastructure, Trojan Horses for Climate Infrastructure. And what she's arguing is that this push for both AI, but also the shift from training to inference could drive a kind of ubiquitous modular data center type setup that allows us to deploy multiple climate technologies all at once. I think that's an exciting potential future. And I think there are opportunities to kind of slipstream this hunger for AI everywhere all the time. What do you think, Yair?
I think I need Hugo to send me notes of all the articles you are sharing with us.
For reference, I shared it before. Yeah, you even opened the Notion. So
I need to catch up on my reading. Look, I think what is very clear is that the Greta moment, 2015, and do good on climate has done very little to push us towards decarbonization. Okay? What is accelerating decarbonization is national security, energy independence. We've seen that in the 70s. So energy crisis, and then the entire wind, solar came, and then the fracking came in the US as well, right? And then the second is, so national security, we see that again, is yet again pushing energy, or let's put that way, changing of the energy source. And then you go towards something that is more independent, and that independent happens to be green. And this is our very belief that the real solutions are the sustainable solutions, okay? And then number two is, as we see here, and this is what we're talking about, is that the need for energy on the AI sector that is driven by AI is in turn bringing more urgency and more customers. And like Jonny said, the interesting customers, those that actually have money and those that are actually agile and are stepping in, not at the pace of the utilities and governments, but actually saying, I need a data center. I need it now. What does it cost me? I'll do it. Hell what, doesn't matter. I'll buy even capacity of fusion that is going to be in 50 years, but I'll buy it now. Yeah. But that's type of how they act. And for us and for humanity, that's good news, because we will get to decarbonization better. And this is great. These are great customers for our companies.
For sure. Well, let's leave it on a positive note today. AI can be good as well for climate tech. Well, amazing. Thank you so much, Maxi, Yair, and Jonny. It was a pleasure to talk again. Loved it. So lots of insight, and I need to reference every article that you've mentioned, including yours, Yair. I love the one on the 1970s that you wrote on wind and solar. So I will also link to this one in the description. Thank you so much, everyone.